If you have been exploring infinite banking or privatized banking for any significant amount of time, you have likely gone to the one place many others would go regarding financial matters, Dave Ramsey. And there's an even higher likelihood you found his videos about why infinite banking is a scam. So in this video, we're going to explain why his beliefs about the infinite banking concept and whole life insurance are misplaced, and where he doesn't give a fair assessment to the benefits. By the end of this video, you will have heard the arguments from both sides, and you can make a more informed decision on whether privatized banking is a fit for you. Which reminds me, this video is strictly for educational purposes only. It's not to be misconstrued as personalized financial, tax, or legal advice. So I encourage you to consult a properly licensed professional before making any decisions regarding your personal financial situation. Now, before going any further, I want to preface everything we are going to discuss with the caveat that this video is not intended to besmirch Dave Ramsey as a person or financial advisor. I am solely scrutinizing the claims he has made in these videos and not the character or intentions from which they come from. Dave has helped millions of people get out of debt, and that is a significant contribution to society. So I want to say this from the start because we're going to challenge one of his most vehemently held stances in the financial world, that whole life insurance is a terrible place to put your money. Now, whole life insurance is at the heart of infinite banking or privatized banking. So if the concept is something you are exploring and you are seeking clarity on it through this video or even through Dave Ramsey's videos, I encourage you to click the link in the description below for my free quick start guide. It will help you understand the concept more clearly and if it is a fit for you. Also, like and subscribe if you like my content. I help teach business owners how to be more in control of their capital within their family and their businesses. Now, for the sake of time, I'm not going to play the entire videos that I'm reacting and debunking, but rather the main claims within them against the infinite banking concept. I encourage you to go watch the videos in full to get a grasp on his full stance and to verify whether I took anything out of context or not. So without further ado, let's get into the first clip.
Exactly.
Yeah.
Yep.
Okay. He's an insurance guy. He's not a financial advisor.
Okay, I was about to
Okay.
say.
So, because those are both mutual companies. Now, there are two types of life insurance companies, mutual and stock. Okay? Likely
Okay.
you bought your term, unless you bought it from him, from a stock company. A stock company, stockholders own the insurance company. A mutual company, which is Pru and Northwestern, State Farm is mutual, is the policy holders are actually the stockholders. Okay?
Okay. Yep.
So when the company makes a profit, the policy holders receive a dividend, as if they were a stockholder and received a dividend. Does that make sense?
Yep. Yep.
Now, follow the math here. If you are the owner of the company and you're also the customer of the company, and the only place the company gets money is from the customers that are owners, and they give you money from a profit, by definition, that means it's because they took too much from you as a customer. There wouldn't have been a profit otherwise.
Okay.
So the IRS has deemed, consequently, that mutual life insurance company dividends are not dividends in the true sense of a dividend, that instead they are, and this is the IRS's language, they are instead a refund of a deliberate overcharge. So they overcharge you in order to give you some money later to make you feel like you're making money off of them. And it's absolute hogwash. It's a pass-through. Mathematically, it's a pass-through. It's the way it has to be. It's the legal definition of the freaking company, and the IRS says so.
So the first point that I want to make is that Dave claims that the only place life insurance companies get money from is the policy owners. This is a half-truth. Life insurance companies receive premiums only from policy owners whom they make a contractual promise to deliver a future tax-favored death benefit to when the insured passes on. The fact that the death benefit from day one is multiples beyond what the premium charge is indicates that the company cannot just take premiums from the policy owner and wait for the claim to come in. they must put it to work so that the earnings can deliver the future death claim. If a life insurance company isn't profitable in their investment strategies, they will not be able to make good on their contractual guaranteed promises. The second half truth is the fact that dividends are deemed a deliberate overcharge by the IRS. Again, insurance companies must put the premium dollars to work in order for amount X in premium dollars today to result in amount Y in the future. The fact is that whole life insurance carriers deliver contractual guarantees. It's one of the only places in the financial world you can find one. This is because they use actuarial science to determine how much they need to charge to deliver John Doe his face amount. They then put a fudge factor or a margin to be extra prudent in their prediction. For instance, let's say for every dollar in premium they charge you, it only ended up costing 88 cents to deliver their contractual promise. Nelson Nash covers this on page 22 of Becoming Your Own Banker. The result ends up being a return of 12 cents of money to you that you already spent. You get to choose what to do with it from there. It's like a contractor who renovates your home and estimates it may take $20,000 to deliver the work that you were desiring, but in the end they only need $15,000 and they return $5,000 back to you. Are you going to say, man, that guy really overcharged us, what a crook? Or, wow, he was very prudent and conservative in his work, and in the end, it cost us less than we anticipated. Now you may be thinking, but Dave is correct in his assessment that this isn't a dividend in the traditional investment sense as a share of profit. To that, I will ask you to consider this. If the IRS tax code is stating that all life insurance dividends are deemed a return of premium, and to Dave's point, it's just a deliberate overcharge on your premiums, why then does the tax code also state that there is a point in which your dividends received can become taxable as 1099 income once they exceed your premium outlay? This makes it obvious that the dividends in whole life contracts with mutual companies can grow to a size where you get more out of it than what you have paid in. And if you receive dividends to a point where it now triggers a 1099, then you must have received a real share of profit off the growth of the company. There's more to be said on why being, a part owner of a mutual life insurer is a good thing, but for sake of time, let's move on.
When you take the money back, you basically are paying an interest rate on it.
Exactly. And whose money is this?
Right.
That you're borrowing your own money and you're paying them interest?
Yep.
This is infinite banking for them.
Yeah.
Yeah, the infinite banking concept is old school, whole life, done poorly. You need a real financial advisor, not an insurance broker that's trying to sell you a load of manure. And so, the other thing is that your cash values that are sitting there all die with you. So whatever cash you put into this is equals zero at your death because they only pay the face value. Pru does not have a policy. Northwestern Mutual does not have a policy that pays more than the face value except Universal Life Bs, which are not in infinite banking products.
Now this part is just flat out wrong. When you leverage the cash value of a whole life policy by taking out a policy loan, you are not borrowing your own money. You are collateralizing the value of the money the company has working for you to pay the future death claim promised to you or your heirs, and the company is giving you a loan in the amount up to that value that you request. It is their money, not yours. This is the beauty of infinite banking. Your money is working in two places at once. Now let's say you are wondering, well, if I pay into this general fund and they lend out from that general fund, isn't it possible it's still part of my money? I'll play ball here. Let's assume out of the billions of dollars in the general investment fund of a life carrier, you end up potentially with the same dollars that you paid in. As a part owner in the company, does that really matter if the profitability of the interest on that loan activity is shared with you? If it's your dollars? This is where Nelson constantly asks us to rethink our thinking. We must think like a banker. If I'm needing a loan, do I go down the street to the credit union I don't own and give them the profitability of my banking activity? Or do I go to the bank I happen to own and do my business there? Not to belabor this point, but Nelson shows this in his famed grocery store example in Becoming Your Own Banker. You make your family buy groceries from your store, not someone else's. You already have a finance need in your life, so why not get a share of the profits on all that interest you're going to pay someone anyway? Dave also loves to lean on the statement that cash value dies with you in his argument against whole life insurance. Again, this is extremely ignorant to how life insurance works. Cash value is not a side account with growth happening within it. That is a universal life insurance mindset. Cash value is the net present value of the future death benefit. It's a meter to show where the growth track of the policy is based on the year you are in, and the trajectory the policy is on to meet the future death benefit. Think of it as a glass of water that is slowly filling up year after year. The pace at which it fills shows it's on track to be full at the final year of the policy. If the insured were to die at any point, the glass is guaranteed to be given to you completely full, including what was already in the glass. At any point, you could decide to get mad and quit. What they would return to you is what you had accrued in the glass thus far. Where Dave's statement is egregious is to assume that when you die, you get a full glass plus whatever was included in the glass before the death occurred. The carrier is delivering you a claim that is multiples beyond what you paid for or had accumulated in it. So why do you expect more than that? The cash value is lumped in the death benefit as it should be. It's not a side account, it's a meter to read how your policy is performing and what you could surrender it at. And in our case with IBC, what you can leverage it for to capture opportunities. One more thing. Dave calls this manure. The irony is manure is what the masses reject as refuse, but for those who know its value, they use it to fertilize growth.
I tell you what, pisses me off. Infinite banking my butt.
Okay, Dave.
Infinite banking is for them.
Yes.
The only thing that agent has for his whole life is a need for your commission to be paid to him.
Absolutely.
That's the only whole life thing that is involved here. These products are horrendous.
Yeah.
And it's bad enough when they feed on the middle class, but that guy's a baby step 7, man.
This is where advisors like Dave try to go for the knees of the insurance professional. Look, life insurance producers get commissions. So do stockbrokers. And advisors get paid fees regardless of how the market performs. So my question to you is, do you want someone that's looking after your interests to work for free? In life, the quality of work is usually reflective of the compensation for it. Now, to Dave's remarks that agents who structure whole life policies for the purposes of infinite banking must be in it for themselves is completely ignorant. If you go watch my video, The Business Owner's Banking System, we discuss how the structure of an IBC policy works. It's the premium structure is built for the use of paid up additions. So the advisor is not getting paid on 100% base whole life, which means the average infinite banking advisor is typically discounting their commission up to 60% so the client can utilize more immediate cash value availability in an IBC policy than in policies that are 100% traditional whole life. That is an advisor that is thinking of his client over himself. What's horrendous is how off Dave is when speaking of an advisor that would sacrifice his pay for the good of his client. There is more where this came from. Dave and other constituents that misrepresent IBC are certainly out there. I will be doing more of these reaction videos, so again, please hit that subscribe button so you won't miss out. The next video, we will discuss how to finance your fleet vehicles without using a bank. I will see you there.